Joe Vitale, Vitale Wealth Management with the Gradient Investments Weekly Market Update. All information is gathered as of the week of March 3rd, 2025. Blessed Ash Wednesday to everyone. As we start Lent, let's get ready for all this. So, and what a fitting way to start, where the major indices ended February mostly in the red. So a little bit in the red this week as we start. The S&P fell 4.6% from its all-time high just 9 days ago, ended the week down almost 1%. The NASDAQ dropped 3.45%. The Dow, however, was a notable outlier, rising 1% for the week. Meanwhile, bond yields fell, with the 10-year Treasury hitting a 3-month low, pushing bond prices up 1.26%. It wasn't just stocks that struggled. Gold also posted its first weekly decline of 2025, and Bitcoin had its worst week since November 2022, plunging 12% on the week and 18% for the month. It got down all the way to 82,000, it's up to 85, so we'll see where that goes. Friday's PCE report came in better than expected, easing fears of a resurgence of inflation with a continual rate pause largely priced in for the Fed's March meeting. Markets rebounded slightly after the report, though not enough to end the week in a positive territory. We've seen a lot of red also this week. Upcoming economic release this Friday, the February unemployment report will be published, so we'll see what that looks like. For the market outlook, so far the S&P companies have reported earnings growth of 17.8%, highest since the fourth quarter of 2021, driven largely by strong performance in the financial sector, which led earnings growth among all 11 sectors. One of the most frequently mentioned terms during the earnings call were tariffs, cited by 221 of the 500 companies, highlighting the uncertainty and political impact on the U.S. businesses. This week, several major retailers, including Costco, Target, are set to report earnings, so we'll see how that goes. Offering further insight into consumer spending trends, meanwhile, tariffs remain a key focus for investors as uncertainty lingers over whether the president will move forward with new tariffs on two of U.S.'s largest trade partners, which is the U.S. and Canada. Once the grace period expires on Tuesday, which was yesterday, additionally a 25% tariff on all products from European Union has been posted, along with 10% extra on Chinese imports. So we're starting to see a little back and forth, where they're a little retaliating back and forth. As we know, this is just basically trying to do reciprocal tariffs is what they're doing. We've been imposed tariffs from them, and it's kind of fair game at this point. So and I think it's more negotiating, but we're going to see how this lays out. How it plays out. Recent activity, there were no changes in the Gradient investment portfolios last week. Stocks in the news, NVIDIA, which is owned in the core selected G33, reported its highly anticipated earnings last Wednesday. While the chip giant once again exceeded expectations, the magnitude of positive surprise failed to meet investors' high expectations. As a result, the stock fell 8.5% on the news. Berkshire Hathaway, which is owned in the core select, reported better than expected earnings last week, with the operating earnings surging 71% in the fourth quarter, and the stocks gained 4.2% on the news. You're going to see a lot of the Magnificent Seven have pulled back. Meta, Apple, NVIDIA, Tesla. So you're seeing all those, the Mag 7, which has basically been running the S&P for the last 15 years for the most part, with especially everybody's like, oh my gosh, I'm making so much money. Well, those 7 stocks are responsible for the majority of the earnings in the S&P 500. The S&P if those 7 lose 10%, the S&P's got to make 20% on the other 493 stocks just to make it even. So there's a huge impact with those stocks. But that's why you're going to see a little bit different. You're going to see the growth and a little bit of value. They work a little bit differently, even though they're all growth. Some are growth value, some are growth core. So bottom line is this: we have to be diversified. I know we've been seeing a pullback in the market. We saw 5%, so basically all the indices are negative for the year, which we started January in a positive light. Now they've all turned negative for the year. Like we said, this is going to be a volatile year. We talked about this for the last few weeks and months. We're going to have volatility. Why? You've got a new regime in. They're doing all the tariffs. They're doing different things. They're basically coming into a corporation, shaking it up, seeing where we're going to cut spending and expenses. However, the belief is once we get all the deregulation and find the spending cuts and lower taxes, the market's going to take off. And I think after the State of the Union address last night, we had a positive rebound this morning as far as the futures were concerned. So the market likes what it's hearing, but it has to digest it all. And until I digest it and see the outcome of it, we're going to have volatilities, we're going to have the pullback. So stay properly allocated like we always talk about. We've got the safe money out there for a reason. So we know the market's going to go up and down, and we can factor that in and take that into account and not have to worry about it. That's it for this week. If you need to get a hold of us, you know the number, 855-756-5700. Visit us at vitalewealth.com. God bless you. We'll see you again next week.